Hi, I'm Lisa Billings. I'm with Warren Averett here in the Birmingham office, and I'm here with two of our real estate specialists to talk about one big beautiful bill and how it affects real estate clients. So I want to turn it over. We've got Cristy Andrews, who is a member in our Montgomery office and leads our real estate practice. And then we have Chris Branch, who is a member here in Birmingham with us. And he is our opportunity zone specialist, among a lot of other things. But we're here to talk about all things real estate.
Thank you, Lisa. I'm excited to be sitting here with Chris today. Good to see you.
Same here.
So one of the first things that really comes to mind that is big for real estate professionals is bonus depreciation. So kind of tell us a little bit about what changed and how it's going to change our real estate people.
Yes, thank you, Lisa. Bonus depreciation under the Tax Cuts and Jobs Act, as many of you know, was set to sunset, and we were losing a piece of it, 20% of it every year until it expired. So we were really excited to see that get added back under the One Big Beautiful Bill and added back permanently at 100%. So as we all know, real estate folks love to put off paying taxes and love to accelerate writing off of their asset. And so this is a great addition, to the tax law and will benefit a lot of my clients personally, in 2025.
Yeah, really exciting to get 100% bonus depreciation back, especially when you start thinking about the rate arbitrage that real estate folks can generate those ordinary losses on the front end and then capture the unrecaptured 1250 gain on the back end. So an exciting development coming out of the One Big Beautiful Bill.
Yes, absolutely. And I think we'll probably see an uptick of cost segregation so that amount can be maximized. So
absolutely. And I love the fact that it's permanent. That's a great bonus. At least as permanent as it can be right now. And so that's really exciting to know that we don't have just a ticking time bomb here waiting for it to expire. It is 100% bonus now. And so, kind of building off of that, something that got a lot of attention was this qualified production property. And I know a lot of real estate professionals are kind of wondering how that works and will it apply to them. So do you want to give a quick overview? I know there's a lot of nuts and bolts to it, but just a real quick overview of it.
Well, it's interesting when you look through this tax bill, you could definitely see some of the things that Congress and the government were trying to do. And one of those was to spur manufacturing on in the current economy, bringing jobs back to the country. And part of that was this additional qualified property and being able to bonus that amount out. I think where it gets a little confusing is I think a lot of real estate folks have been asking, is this something that they could get into and possibly, build and rent? And it really isn't. It's written really to benefit manufacturing companies that build the facilities and operate the facilities here in the country. So, Chris, I don't know if you've gotten anything else out of that, but that was my big takeaway.
Clearly, they were trying to incentivize, bring that production back domestic, back into the U.S. It's unfortunate that they specifically excluded that lessor-lessee relationship,
Yes.
But that we still have time for regulations. We'll have to see what Treasury and the IRS has to say about the final kind of pieces to the bill. But yeah, as of today, that is clearly pushed more towards those manufacturers rather than it being real estate professionals.
Yeah, that's a good point because we don't have the regulations, yet. So it'll be interesting to see, when those come out.
Absolutely. And if you're a real estate developer, maybe it changes how it looks and maybe you're not the owner anymore. But, if you have a manufacturer client, it's a good time to be developing for them. So hopefully, I think it will spur some development and some construction. So it will be interesting to see as these rules really come out, and people really understand all the ins and outs of them, how it spurs some of the growth. One other thing that's gotten a lot of attention, it came out in 2017 in the Tax Cuts and Jobs Act, is, the business interest expense limitation, or good old 163J, as we all call it. Nobody outside of tax world calls it that, but we do. And there were several changes to it. How would those changes, kind of affect our real estate developers and owners?
Well, not to get too far into the weeds of the calculation, but the 163J limitation limits the interest deduction by your adjusted taxable income. And in calculating that, as the Tax Cuts and Jobs Act, moved on down the road, they wouldn't allow you to add back depreciation, amortization. And so, of course, that, made that deduction smaller and smaller. With OBB, they allowed that to come back. So that amount is going to increase the amount of interest expense that you can take if a real estate person doesn't go down the path of taking the real property trade or business election. So there already is kind of an out on that for real estate professionals, thankfully. But if for some reason that just doesn't make sense, it's definitely turned to a favorable tune with OBB. So that's good to know.
Absolutely. And then there were some other changes as well to 163J that may not be quite as favorable. But again, luckily, most real estate professionals have the real property trade or business election that kind of gets them out of this. But if for some reason you haven't made that election, I think it's something definitely to call your advisor and talk to them about.
Yes, absolutely. They clarified a couple things as far as when the calculation needs to be made. It needs to be made before you start capitalizing interest, which is huge for real estate professionals. So it just really is something very complex that needs to be discussed with your tax advisor beforehand when things can be changed or revised.
Yeah.
So.
Absolutely. And so finally, we just want to see if we can talk a little bit about Opportunity Zones 2.0.
How long do we have?
I know. I think Chris could talk about this all day.
That could be a 2-hour class.
Opportunity Zones 1.0 was part of the Tax Cuts and Jobs Act. It was a sleeper provision that nobody really thought very much of until they started really digging in and seeing where these opportunity zones are and kind of how it worked. And then all of a sudden, it really did drive a lot of economic development. And so the original program was set to expire in 2026, correct?
Correct.
Okay, make sure I get that right. And then, but now we have Opportunity Zones 2.0. So tell us a little bit about it. Of course, not a lot to know right now, but there's enough.
Just like round one, there will be plenty of regulations to come to kind of give us some more detail about OZs 2.0. But really, let me just kind of give a quick of the changes from round one. So, of course, OZ's round one, as Lisa, you already mentioned, was set to expire at the end of 2026. All of this deferred gain that investors had rolled into these economically depressed areas was all set to be recognized at the end of 2026. And that is still the case for OZ's round one. OZ's round two has created a 5-year rolling deferral period. So when you put cash into an opportunity fund, you're going to defer it for 5 years, and then it gets included back in taxable income. There was also in round one an opportunity to have a small haircut on the original deferred gain. It was 15% if held for 7 years, 10% if held for 5 years before that December 31st, 26 date. That is now a 10% haircut as long as you hold your investment through your 5-year deferral period. And then the big one that remained from OZ's round one is that if you hold your investment for at least 10 years, the appreciation on that investment becomes tax-free. I do want to reiterate that it is the appreciation on that investment. The original deferred gain is always going to get included back in taxable income, but there is an opportunity for that investment to grow tax-free as long as the holding period is met. And then the only other thing is that the map is going to change. So OZ's round one, kind of a wide opportunity for multiple different types of zones to roll in, even zones that didn't technically qualify but were contiguous to zones that qualified, were eligible for designation for OZ purposes. That has gone away for round two. So round two, they've definitely shrunk the map. That the expectation is that the map is going to be formed over the second half of 2026 and it'll be placed in service January 1st of 2027. There'll be a small overlap period where the zones now will roll all the way to December 31st, 2028, but the new zones, the new map will go in place January 1st of 2027. So a lot of exciting things with OZ's round two. We'll see what the regulations provide to continue to help to mold what those investments are going to look like.
So who defines the zones? Do you know?
I do. So that runs through basically each state, runs through the governor.
Okay.
So we'll see who the governor is that's going to designate those zones. But yes, those run through the states. So yeah, those zones are going to be designated by the governors, by that office within each state. Those zones are then going to be provided to Treasury over the second half of next year. And then Treasury will actually start to lay out the map and designate those zones to start January 1st of 2027.
Interesting.
And I think one thing to kind of keep in mind, in order to get this favorable treatment, you have to have gains to defer.
Specifically,
and
capital
so that
gains,
is
correct.
Yes, exactly. And that is something that I think people forget about, because you think like a normal real estate investment, well, I just put my money in and it's in an OZ, I should get benefits. But you actually do have to have gains to defer in order to get benefits in an OZ.
Correct. That is number one. There's really no point in even going down the route of an opportunity zones if there's not a capital gain out there, either recognized within probably the past 180 days, or if you've got a gain coming up in the future. But we've had a number of those conversations with clients and prospects over the past several years, and looking forward to continuing that into the future.
Absolutely. And I want to touch just real quick on one other thing with OZ 2.0. I keep on hearing something about a rural zone. What is that? Tell me a little bit about that. I know we could probably go into tons of details about it.
I'll make it quick, because I think this is clearly they're incentivizing rural investment. I think that is going to be extremely beneficial, but they've created a new class of opportunity funds. So clearly you had your original class of opportunity funds, you had your certain requirements you had to hit. With a rural opportunity fund, you take your substantial improvement threshold, which originally that was you had to double the basis in the real assets. That is getting cut to 50%. So $100,000 investment becomes only needing to put $50,000 into that investment for it to qualify for OZ purposes. The tax incentive for the rural opportunity zone is that the 10% haircut that you would receive after that 5-year deferral period becomes 30%. So definitely incentivizing, trying to, in my opinion, bring up Main Street USA, is those left behind communities that are sitting in rural opportunity zones. And real quick, just this is a very high level definition. We'll see more as the regulations come out, but they've kind of set it as the USDA definition, that it is less than 50,000 inhabitants in a city or town is what's going to qualify as a rural opportunity zone. So looking forward to seeing how all of that develops over the second half of next year.
Absolutely, because I think that's the other thing to kind of keep in mind is all of these changes don't take effect until 27 in opportunity zone world. A lot of the other big, beautiful bill changes take effect in 25 or 26, but opportunity zone is a 27 item. So it's good and bad. I guess we have a little bit of time to figure it out and for Treasury to issue some regulations, but there's also a waiting period for this one.
Correct. It seems like there's going to be a little bit of an investment dead period between now and 2027. I don't like that, but I do like the opportunity to understand the rules a little bit better before we dive into 2.0. But I definitely think you'll see a decrease in the amount of investment within opportunity zones until the new program has started and the new map has been laid out.
Awesome. So what's your advice for a real estate investor with all of these tax changes? What do they need to be doing?
You got to find a good advisor. There's so many changes. There's so many things. You know, the Internal Revenue Code, it's always an it depends, or there's a caveat somewhere. There's no difference with all of these different one big beautiful bill provisions. So definitely find an advisor you can work with that understands the rules, that understands your business.
Yeah,
Cristy?
I mean, to me, it's discuss these things with your advisor early. The earlier, the better. Make sure they're included on the structuring of your deals while the structuring is happening, while the deals are being formed, just to make sure that everything's been thought through, because there are so many caveats and there are so many, well, if this situation, then this, and all of those type of things that you really need to think through it with your tax advisor.
Absolutely. Well, thank you both for stopping by today, giving us a little overview of how One Big Beautiful Bill affects real estate. And please reach out to us at Warren Averett if you have any questions. We are happy to talk to you, talk about your business, talk about your real estate deals. We love talking about real estate around here. So please feel free to reach out if you have any questions.
Thank you, Lisa.
Thanks,
you,
Lisa.
Chris.
Yeah, thanks, Cristy.